welcome to another episode of Craig McKinnis, Craig Mack's Chasing Success. I'm your host, Craig Mack. With me today is Tim Hendricks. He is the CEO of Creed Partners, the Creed Partners organization. And so, Tim, say hello and tell me about the business.
Hey, everyone. So Creed Partners started off with three legs. One was managing a family office. So that was a client partnership we had. And one was doing freelance business development for commercial builders. And so basically, I would bring a handful. I've got selected clients that do commercial construction, and I'd bring them a client and they would pay me for that service. And the primary leg of the stool was commercial loan brokerage. And so that's really where it started. It did shift because we started the business in 19, but probably in mid 20, maybe 20, early 21, I went to my business partner, which was that family office, and said, "Hey, what do you think about this? I'm going to sell all of my assets in Florida, buy a pickup truck and an RV, and go tour the country with my wife and three kids before they get old." And he said, "Tim, you'll never regret it. Go spend time with your family. We can make a living some other time, but if you can enjoy spending time with your family, that's what you should do." And so uh, basically, I took over 100% of the company in January of 22, which is when we left out on the trip. And so I worked remote, just basically doing commercial loan brokerage in 22 and 23, and that's what we do today.
Wow. Wow. That is awesome.
It was a wild adventure. To take somebody from corporate America that had a desk job for 21 years, and you and I worked bank receivership stuff out in California, so we're in cubicles, we're in offices,
Right,
it's corporate America,
right.
and to not only take me out of that structured, comfortable environment, but we basically, it was my wife and I, three boys. We've got a high schooler, a middle schooler, a grade schooler. We had a dog when we started. She's since passed, but we were in, we went from 1,900 square feet to 275 square feet, and it was moving all over the country.
Wow, you guys got pretty cozy with one another.
We did, and my wife and I are still happily married, which is what all the guys want to know. How are you guys? It, but it was wonderful. Like I said, I was the most apprehensive about the trip, and I'll never regret it. The boys want to settle down, and we're back in Central Florida now, and we're plugging into church I grew up in, and so there's a community here with family and friends. But if my wife and I were empty nesters, we just keep going.
Wow. Well, I know you're a man of great faith. I love your spirituality. Where'd
Thank
you
you.
grow up, Tim?
I'm one of those few people that are a native of Orlando,
Okay.
because so many people that are born here, I guess they just get jobs elsewhere. Now, with the population increase, post COVID, a lot of people have moved to the state, but I was actually born in downtown Orlando.
Wow. Okay. All right. How did you get into the business? I mean, what made you go into that line of business?
Sure. Well, when I first got in the banking business, I was in college, didn't know what I want to do. And I had an older fraternity brother who was one of my closest friends. He offered me a job in banking. And I said, "No, you shouldn't hire me to be a banker. Math was my worst subject in school." And he told me that banking is people skills. And so that was in 1998 when I first started in banking. The reason I wanted to leave the industry and start my own firm was I really wanted the freedom and the flexibility to make my own schedule.
Hmm. Yeah.
Yeah,
Okay.
and it
Right.
it it
Right on.
affords me that. I mean, you take on all the risk, but you also reap the reward. And my
Right.
intent was not to try to do more income necessarily than I had done. A lot of people have that aim, but for me, it was just replacing the income I had for my family, but also capturing my time. And so maybe it was idealistic, but if I could make the same money I was as a banker, but work 75% of the time or 50% of the same amount of time, then I call that a very efficient way to go.
Okay. All right. Right on. Right on. So, what's been your biggest challenge so far in your business?
Well, the last couple years, it's been interest rates. So, to boil down what we do is if someone comes to me and wants a commercial loan, most of what I work on is investment real estate. Some of it can be, what we call business banking or C&I stuff. But somebody comes to me, they have a financial need where they need to borrow money for something. And I connect them to a lender. And that lender, oftentimes people think brokers are just used for hard money or private money, but we originate for life insurance companies, CMBS debt, agencies like Freddie, Fannie, and HUD, also institutional and individual private money, which includes hard money, and of course, banks and credit unions. With that, the last few years, rates have been on the rise.
Mm.
And so oftentimes the higher interest rates don't fit into the investment model either of an investor or a business owner, where the deals make sense anymore. The
Mm.
other thing too is the bankers and credit unions, they lend out a bunch of money during the ramp up in the good times. So their portfolios are full of loans, which is good for them. But they had a lot of money run out of the bank, from on the deposit side whenever rates went up because everybody was taking their money out chasing yield elsewhere.
Mm-hmm.
So a lot of banks and credit unions are maybe full of construction loans already, or full of a particular asset class like hotels, or self storage. In addition to that, what we call a concentration of credit, they also have a high percentage of their deposits in loans. And as you know, we've worked, as a contractor to the FDIC. They want to make sure that banks are very safe and sound, and they don't have too many loans compared to their deposits.
Mm-hmm.
And their ratios, some of the ratios are up as high as they want them to be. Some are getting closer to over. And so they really have to watch that. So the biggest challenge I'm facing is matching the lenders, having enough financing supply to meet the demand.
Mm. Okay. So
Yeah, tough to
what's your
find
biggest
loans
need
today.
right now?
What's that? No, the
What's your
biggest
biggest
need,
need for your business?
just more lenders, basically. I've got lots of lenders. Bridge lenders I think are going to come in handy in the next few years as we kind of transition through the maturity dates. There's a lot of commercial debt that's going to be maturing in the next 3 to 5 years,
Mm.
and I think we may just be kicking the can on a lot of it. And bridge loans allow people to refinance interest-only payments, maybe at today's market rates, maybe a little higher, and kind of extend it until rates come down, perhaps, or things change, and then you could refinance it with a mini perm or a permanent loan. But um, it's tough finding lenders. That's what I need today is just more sources of capital that are looking to deploy it, because nationwide, the capital sources, it's just very tight today.
Mm. Okay. So I know your business is very sensitive to interest rates. So what camp do you fall into as far as, rate cuts this year? Is it going to be, are we going to get any? Are we going to get one? Are we going to get two this year? Or do you think they'll push it out to next year?
Well, a lot of conversation happens around that very discussion. And my answer is not pleasing the most because of my bank experience, people ask me that question, or because I'm kind of into the economy. I have no idea. We are in such a strange environment right now where I know the government is watching inflation, and they're also talking with the banks and watching their loan portfolios and their liquidity positions. I really don't know.
Mm.
Um, you know, in the course of someone's lifetime, they probably lived through several up and down cycles of the economy nationally. Uh, we're kind of in a quagmire. The bankers that I'm talking with, they say, yeah, we may want to lend some money to some owner occupied businesses, or maybe for some working capital for some businesses. We're not doing much investment real estate today, but if it's not perfect or near perfect, maybe we don't want to lend any money today.
Mm.
And so there's very few lenders that are actually deploying capital today. Um, Also, in addition to all of this, with the higher rates, it's an election year,
Mm.
and so regardless of the political sides, businesses pause during a normal election year because they don't know if the person's getting elected is going to be pro business or not pro business, and so they just kind of pause and freeze up just to maintain. And
Mm.
then if they think that it's going to go pro business with the election, or if they wait till after and they know, then they can decide, okay, am I going to start spending money, maybe hiring additional people, or buying some inventory to make some widgets or investment in some projects. Um, I think we're just gonna kind of bump along. And I definitely don't think that we're going to see the rate decreases that we thought we would see when we were talking mid last year or late last year that we thought were going to happen. I thought we are going to see several this year, but they were going to be very small incremental changes. Now I'm thinking we may not see any changes, and if we do see some, they're going to be less of them and they're going to be smaller amounts.
Hmm. Well, because here's my take on it. I don't think we're going to have any rate cuts this year. I
Zero.
think
Okay, interesting.
if we have any, they'll be maybe mid to late next year. Because the thing
Yeah,
for me is that if the Fed is cutting rates, that means the economy is struggling and they
right,
need to stimulate it again.
right.
Also, I think, we're all hung up on these rates. To me, rates are at a normal rate level right now. They're at a normal
That's
level
right.
as far as I'm concerned. You,
That's right.
you have to remember, we
Historically,
came out the Great Recession. They had to take the rates down to zero to try to stimulate the economy. And they were trying to bring them back up again so that they can normalize. But they were
right.
down so long, it became normal that the
That's
rates would
right.
be that low.
Yeah,
They
I
need that.
agree. I think historically, we're in the middle from what we've been. Now,
Yeah.
and this brings up a different interesting conversation. I was having this with my uncle. He's retired, but he worked in Chicago, where you're from, for years and then moved down to Sarasota, Florida. But we were talking about it, and people his generation tell people my generation, "Hey, this is a normal rate environment we're in." It's I mean, we've had so much more. The difference, though, and I read an article about this, maybe on LinkedIn, I forget where it was posted, but the difference is if you look at the cost of a home with the higher rates then compared to the cost of a home with the higher rates today, we might say we're in the middle on the rate side versus 12% or more. However, look at the cost of home versus average income, median household income. So back then, if rates were in the 12s roughly, but the houses cost $100,000, but you might make $50,000. Today, if you're making $100,000, houses cost half a million or 400,000. So instead of being double what your median household income might be for your house, it could be 3 to 4 times or more as much as the median household income. Wages just have not caught up with the rate increases.
Yeah, yeah, that's true. That's true. So where do you see your company being in the next 5 years?
That's a great question. I would like to see it being in a place where I've built deeper relationships with my clients because we just started this in 2019, and the majority of my focus in 20 and 21 was working with my family office partner. And then we took off on the RV trip in 22 and 23, and I was working with a couple other loan brokers as well. Great partnerships there. But what I'd like to see happen in the next 5 years is for me to be able to deepen my client relationships with the borrowers. So I would be the go to for them with any financing, whether I placed it for them or if I was just a soundboard advisor for them, the first call. And then on the lender side, certainly more lender relationships, deeper relationships. Um, I love people, and so I want to build and maintain more of those borrower and lender relationships. And so I think hopefully it'll be an interesting time the next 5 years.
Mm,
Uh, Oftentimes, I don't think character is necessarily built during the downturns as much as it's shown. And
mm.
so I'm sure that I'll be able to meet a lot of nice people in the next 5 years and develop some relationships. But I would like to see it become a little more efficient than it is. I feel disjointed sometimes
Mm.
with the way that we operate. And so maybe I can create some efficiencies between now and then. But basically, I've been, on a long vacation for 2 years. So now it's time to get to work.
Right, right. Okay, so what's your strategy for deepening those relationships and attracting more lenders? And what's your goal for 2024?
Basically, for 2024, um, I think the goal might be connecting the borrowers to some type of bridge financing.
Mm,
I don't think there's a lot of longer term Construction financing is very tight. So I think this might be the year of bridge loans or some type of alternative finance. Um, the strategy for relationships, I like to pick up the phone and have conversations with people. Doing
Mhm,
things like this, where you're on a Zoom call, is okay as well because you're
mhm,
seeing the person. So, we've all learned through COVID that you can do that. Um, I do like text messaging and email just for the speed, but that's more data driven versus tone and inflection and real relationship building, getting to know somebody. And so while I'm probably the only banker in America that's not into golf that much, um, it's still about doing things with those people. And the way you build a relationship is spending time with them.
mm,
And so it's the time value of money too. So you have to balance spending your time to build those relationships. Um, because if income were not an issue, then I'd be friends with everybody. But you have to really measure the time you spend to build those relationships and compare it to, what's the return on your time investment with those folks. But I love the telephone. Zoom calls are good. In person's my favorite, always has been. I like to say you go out and you shake hands and kiss babies.
mhm.
And so you go to all the networking events, the trade organization events. I love doing those type of things. And now that we're done with the trip, I'm back in Central Florida. So at least statewide, if not in the Southeast, then I can get out and meet people in person and visit
Okay.
and also obviously when you're talking with lenders and borrowers, you can visit their sites, and that's always fun too, is to do site inspections.
Now, do you only do business in Florida?
We don't. Most of what I do is in Florida just because I'm from here and that's a lot of my connections. Um, Real estate's always location, location, location. So it depends on the type of loan. Generally speaking, if it's a construction loan, then if I have a lender that's near the project, then it might work. I might be able to serve that borrower and connect them to the right lender. But oftentimes the lenders want to be near the project because they've got to hire a third party, not all the time, but they've got to hire a third party to do the inspections on the project. So they'd like to be maybe within the state or so. Um, if it's a larger loan, something that might fit with, say, an agency, a U.S. agency, or CMBS loan, or life insurance company, those loans can be anywhere in the country. They do like to see the assets in primary MSAs or secondary. The farther out you get from kind of a downtown area, then the less interested they become. All that to say, primary is Florida, secondary is the Southeast, and then tertiary would be the entire country. So we can lend coast to coast.
Huh. Let me ask you this: Do you have you considered, or do you target a specific industry sometimes?
I do. Um, when I was a banker, I did investment real estate, I did home builder finance, I did development of both. I also did a few SBA loans. I'm somewhat familiar with SBA, business banking, not a lot of corporate finance, a little, not much. My personal leaning and what really got me into banking to begin with was back in college, I was buying rental houses around the college campus where I went in West Kentucky, a school called Murray State,
Hmm.
and I needed financing for that. And that's how I met an older fraternity brother that was working for a bank. So really what I enjoy is real estate and investment real estate. And so that's kind of where I focus on those asset classes. Office is going to be tough post COVID. Industrial, retail, I think, is stronger than people thought it would be because even though Amazon's around and we thought we'd be getting deliveries from drones by now to our doorstep,
Hmm.
there's certain types of retails that'll still be around. There's going to be nail salons. There's, and a lot of mix too. In retail, you see
Hmm.
sometimes medical office goes into retail, or you can see life insurance or not life insurance, but personal lines like a State Farm office or something like that.
Hmm.
So you see kind of a blend between office and retail in some of the retail spaces. I've seen churches go into retail as well.
Mm.
Um, and then multifamily, of course. In Florida, COVID, of course, with the pandemic, hotels really took a beating.
Mm.
But I've seen them come back first on the personal travel and then on the corporate travel. So hotels in Florida, I think, are stronger than most people think. They're really making a comeback. But
Mm,
multifamily is a place where we don't have enough housing for the demand in Florida right now. But the capital markets are looking at it saying, are we starting to overbuild? Because in Florida, the lenders that I talked with thought we might be reaching that threshold before COVID. And
mm,
now we have a lot more people moving to Florida. But multifamily, I served as the investment officer of a private development company in mini storage and boat and RV for a couple years and enjoyed doing that. And so I've got some firsthand experience in the storage industry, which I still enjoy. So I like financing storage properties as well. I've done a few churches in my time. Um, let's see, what other product types? Really anything, home builders, good, development. I think the reason I'm drawn to construction is because I enjoy seeing things get built,
mm.
literally. I put together a capital stack with a borrower. I help them structure the debt on it. They bring the equity. We go to the lender. We partner together. And it's like an orchestra. You've got so many different players coming together on a development or construction project. And I just like to have my place in that orchestra and like to watch it. And my kids and my wife, they get so tired of it sometimes if we're driving around different places and I'll say, I finance that. I finance that. I probably need a dose of humility in that regard. But
That's got to be
so,
pretty cool.
well, it is, I mean, because you can say, I help do that.
Right.
And so it's pretty neat. So I do kind of lean towards certainly investor real estate, but more so probably development and construction.
Okay. Now with AI is real hot right now. And I think what people miss or may not understand about AI works only as good as the data. And
Right.
so you have a big push right now on building data centers.
Mm.
Do you see yourself maybe getting any opportunities to do that?
Very possible.
Okay.
Industrial's been good for that reason, but also a lot of folks have been going to cold storage. And if you think about it, if you've got, say, a large poultry company or a certain large food provider, they're not in the real estate business. And so they go to real estate investors and say, hey, we'll sign a long term lease with you. We might be a credit rated company, large company, financially strong. We'll sign the lease so that it'll help you go get your financing. But one of my partners did two large cold storage facilities. This was in the Midwest, and I believe he did one in 22 and one in 23. And on the industrial side, not only the data centers, but also cold storage.
Mm,
So, and in addition, on a smaller scale for industrial, and I've known the demand has been here for a long time in Florida, but what we call small bay. So small bay's got a lot of uses because small bay might be 1,000 to 3,000 square feet, and you might have a regular door with a little office perhaps, and then a roll-up door. And you walk in, you may have a mezzanine space, you may not. But these small bay warehouses can be for lease or for sale. But either way, you think about it, the the target market for that may be a hobbyist, somebody that has a side hustle. It could be a full-time person that owns maybe a lawn company or something like that.
hmm
They need a place to put their things. So it could be a full-time business owner, a part-time business owner, or it could be affluent individuals. I talk to a lot of people in Seminole County, Florida, and Volusia County that own collector vehicles.
mm,
And they might use the small bay warehouse to own it. They'd rather own call it 1,500 square feet and put
hmm
their cars or their toys in there than have to pay somebody at the storage facility, the boat and RV storage facility, because
mm.
then they can make it their own. It might be sort of a man cave, if you will.
Right.
They might have something up in the mezzanine space, a couch or TV or something like that, but
Wow.
down below, they might have a couple collector vehicles, and
Right.
so it's a pretty broad target when you think about who could be your tenants or who could be your buyers. But I love the small bay industrial space. But it's tough from a sales perspective, and the brokers know this, and some bankers know this. But oftentimes, you don't have pre-sales in that niche market. When you get from industrial and then go down to small bay, you really have to build it spec, and it kind of falls back to that build it and they will come. The
Mm,
demand does exist, but you really get as a seller, you really get your best prices if you don't have pre-sales and you start to market it as you're building it. And that's tough with lenders. Lenders love to see pre-leasing and pre-sales. I understand the risk, but for that particular product, I do have some lenders that are really in tune with small bay, so they get it.
Wow. Well, Tim, you have taught me a lot today, my man, and it's been a while since I've seen you. You look good, and I'm glad you're
Thank you.
doing well.
Good to
And I
see you
wish you
too.
the best of luck with your business.
Thank you.
Again, this is Tim Hendricks from Creed Partners. Sorry,
Sure.
Creed Partners.
That's
And
all right.
thanks again for taking the time to talk to me.
Thank you, Craig. I wish you all the best.
All right, take care.
All right, you too.